Hey guys, welcome back. We are still doing the November 2016 question paper, focusing on question 4. We had just answered the question on calculating asset test ratios, debt equity ratio, etc. To find those ones, you'll find them in the previous video. So please check them out if you need any clarity on that. And we're continuing now to question 4.2.5. This one says the liquidity of the company has improved. Quote 3 financial indicators to support the statement. So this is very structured. It tells you that it has improved. The only thing you need to do is to provide indicators to support the statement. It's not asking you whether or not the statement is true. So here you're not going to express any opinion, but rather support the current existing opinion. So let's go. Let's look at the liquidity ratios and see if there's actually any improvement. So asset test ratio, it went from 0.3 is to 1 to 1.6 is to 1. Asset test ratio, we calculated it as 0.7 is to 1, and it was coming from 0.1 is to 1. And then the stock turnover rate did well, so it went from 10 times to now 8.5 times. That does not show improvement. So the stock turnover rate is about how quick do you turn stock into sales. So in the previous year, you did that 10 times, and then in the current year, you did that 8.5 times. So that's not a good indicator for improved liquidity. So you'd not quote that one. And then the debtors collection period, it says that it went from 43 days to 36 days. That shows that you're collecting money way faster than you did in the previous year. So that's a positive. We can quote that one as well. And then creditors payment period, you can see it remain the same, so it doesn't show any improvement. So it's clear that you're going to quote current ratio, asset test ratio, and debtors collection period. And then to code that, you would say, you'd start with the current ratio. Let's say current ratio improved from 0.3 is to 1 to 1.6 is to 1. And then secondly, acid test ratio, acid test ratio improved from 0.1 is to 1 to 0.7 is to 1. And guys, when we're talking about the acid test ratio, we obviously calculated this in the previous video. So if you didn't see that, maybe go watch the video of how we calculated it, and then you'll be able to quote the ratios as well. And then we won't quote the stock turnover rate because it didn't improve, and we also won't quote the creditors payment period because it also has not improved. And we're going to say debtors collection period. This one is a given, improved from I think 43 days to 36 days. Let me just confirm it. Yes, it's from 43 to 36 days. So we got that one right. And that is an easy 6 marks. Cool. Let us continue then to question 4.2.6. So they say the dividend policy, provide calculations to show how the change in dividend payout, policy, explain why the directors decided to change policy, state 1 point with figures. All right. So let's go through these calculations. So, you know the dividend payout is basically the dividend per share divided by earnings per share. So that's the payout ratio that you do. So if we go and look at our ratios, let's look at the ratios. So in 2015, the dividends per share is 35 cents per share, and then the earnings per share is 58 cents per share. So of the 58 cents that they generating profits. They paid 35 cents of that to shareholders. And then in 2016, they generated 51 cents in earnings, but they paid out 55 cents. So that is higher than, so they're paying more dividends than they're actually making money in 2016. So that is a bad look on it. But let's go and calculate the ratios first. So I want to start with the 2015. Let's start with the 2015. So obviously there's 35 cents divided by 58, multiplied by 100, whatever, but we get 60.3%. 60.3% of earnings paid over to shareholders. And then 2016, we have 55 dividends per share, and then we have earnings per share of 51 cents, and that gives us 107.8%, 107.8%. The business paid more dividends than the profit generated. So they paid more dividends than the profit generated. In other words, they dipped into their retained earnings. And you can see from the calculation that we did on retained earnings that the retained earnings between 2015 and 16, they have actually decreased in 2016. So they dipped into the retained earnings that they had to pay more dividends. And then they say, explain why the directors decided to change the policy. So why they decided to change the policy, state one point with the figures. So one of the reasons that I did look at, if you look at the market price of shares, you can see there you have the market price of shares was 1,030 cents, and then in and then in the following year, the market price dropped to 1,000 cents. And if you look at the return on equity, which we calculated in the previous question, we calculated it as 4.5%. So that's the return. So the return on equity dropped, and also the share price dropped. So in order to compensate shareholders for those losses that they incurred, I think the directors may have decided to pay out more dividends to shareholders. So you may say why directors decided to change the policy. This is to satisfy shareholders because the share price dropped from 1,030 cents to 1,000 cents. The return on equity also reduced from 6.2% to 4.5%. So I think that would be the reason why they would have changed the dividend policy that they had in the first place. Cool. And then question 4.2.7. Let's try and answer that one. So yeah, the information says Mary is the CEO of the company. Her shareholding is as follows. She owned 420,000 shares that she had purchased on the 10th of January 2015, and she's the CEO of the company. I'm going to say calculate Mary's shareholding on 1 October after the repurchase of shares. All right. So at the beginning of the year, we do know that if we can look back into the other work that we've done already, you can check the previous videos. So with 900,000 shares in issue on 1 July 2015, and she owned 420,000 of those shares. So she was not a majority shareholder, because in order to be a majority shareholder, she should have owned at least more than 450,000. And then there was a repurchase of shares. So the shares issued then would have went from 900,000 to 825,000. So to calculate her percentage shareholding, we would say we'll take a number of shares, which is 420,000, and then we divide by 900,000 minus 75,000. And then we'd multiply that by 100. And then that would give us a percentage shareholding of 50.9%. And then explain how Mary has benefited from the decision to repurchase shares. So she obviously benefited because she became the majority shareholder. More than 50%. That's what we mean by majority shareholder. She owns more than 50% of the company. And then the question that follows after that, it says the independent auditor discovered that Mary had made the decision to repurchase shares without informing the board of directors. Why should the independent be concerned about this? Well, firstly, she's the CEO, so she might have sidetracked some of the other board members into making that decision to repurchase the shares. But so in that case, it would display some form of bad corporate governance, because you ought to be transparent to the rest of the board about the decisions that are being made. So that is a bad corporate governance. It's bad corporate governance, and it means that she's not being transparent. Bad corporate governance as it pertains to transparency. And then also, she can not legally make such a decision without the board approval. So that decision would need to be looked on and see if she is breaking any laws as it relates to the Companies Act, because she ought to have other directors voting on the issue and going ahead then with the repurchase of shares. Cool. And then let's go to question 4.2.8, which is the last question of this question paper. It says here, the cash flow statement reflected fixed assets to purchase fixed assets purchased to the amount of 4.5 million, and then say name two major sources of funding for those fixed assets, figures that are over 1 million each, and then state each source, whether it was a good or bad decision, explain your choice, and quote relevant financial indicators to support your decision. So let us go. So the first source for me, obviously, it's the loan, because the business took an additional loan of 3.5 million, as we have calculated. Loan of 3,500,000. I'm just going to show you now in the question paper. So if you look at the loan was 4.5 million at the beginning of the year, and now we're sitting at 8 million. And we also did calculate the difference in the previous question. So you just have to look at the previous videos, what we had calculated. So yes, so this was calculate the change in loan in the cash flow statement. So we'd have 3.5 million, right? So the loan of 3.5 million, and then the second source, there's two sources of funding that the business can have. The business can issue shares, or it can borrow money from a financial institution. So the other one is obviously then the issue of shares, issuing shares to the value of 1,350,000. And also to get this information, this is something that we had also calculated previously when we did the issue share capital note, the ordinary share capital note, and we calculated it to be 1,350,000. Sorry about that. Cool. And then now the second thing that you need to do is to say whether it was a good or a bad decision. So in my case, I mean, I'll say this was a bad decision, and I'm going to explain why. So I'll say this was a bad decision. So the reason for me then it would be a bad decision is because if you look at the, so we had a, if you look at, firstly, if you look at the solvency ratio showed a decrease, so 2.6 to 2.2 is to 1, but that's not really that bad. So you still have some leeway, you have more assets than liability, twice as much actually. But if you look at the debt equity ratio that we did calculate, it went from 0.5 is to 1 to 0.8 is to 1. Let me just show you where we calculated the debt equity ratio. We calculated the debt equity ratio to be 0.8 is to 1. So it increased the financial risk, the financial gearing. So I would say the financial risk of gearing went from 0.5 is to 1 to 0.8 is to 1. Cool. So I mean, you can see here that the business was using about, now the business is using, for every 1 rand that they have in equity, they have 80% of that in liability. So that is, the business is operating at a very high risk, and if the business does not achieve its objectives with the assets that it acquired, then it can be very difficult to pay back all those shareholders. And also, if you look at interest rates, so the interest rate is 12%, and the return on shareholders' equity is 4.2%. So which one would you want to pay? 4.2% return to shareholders, or do you want to pay 12% interest on loans? So you can see here that the interest rate on loans is much higher than the return on shareholders' equity. So for me, I would rather source money from the cheaper source rather than source money from loans. So the second decision, this is what I would call a good decision. Good decision. Good decision. And then my reasoning there would be it is a cheaper source of funding. This is a cheaper source of funding. Return on shareholders' equity is 4.5% versus interest on loan of 12%. And therefore, that would be the reasoning that I have, that it's a good decision that they did, because it cost them way much less to have money on shareholders. And also it's just low risk, because I mean, shareholders, they own the company, they're not owed by the company. So in a year that it's difficult to pay out a dividend, the directors can simply not pay a dividend. But in a situation where you can't pay your liabilities, then the companies may attach and the business may have to close down because of not being able to pay the liabilities. And that brings us to the end of our lesson and the end of question 4. We'll be meeting again to do question 5 and finish up this question paper. Thank you guys for joining. See you on the next one. Cheers.